Okay, thank you. Well, thanks, Sophie. I hope the slides on the screen are visible now.
Yes, they are.
Well, thank you. As said, we at the AFM also, of course, saw quite an astonishing development in the market for sustainable bonds since a few years. So we also considered whether or not we should have a role here and to have a look at this market. And that's why we started the project a year ago. In fact, if you look at the mission of the AFM is kind of the conduct supervisor in the Netherlands, and we look at promoting fair and transparent financial markets. But our mission also states that as an independent market conduct authority, we contribute to sustainable financial and prosperity in the Netherlands. In that respect, also the sustainable element of this market development is in our interest. Therefore, support the positive development for transition to a sustainable economy. But we also wanted to know exactly what was happening in this market, because we have typical conduct already and supervision in the bond market in general, but this was a new development. So therefore, we made an exploration. Let's see if I can just put the next slide on. We did some desk research, some data analysis ourselves, and most importantly, we had talks with around 20 market participants. I saw some of the people we talked to also in this webinar, so that's good to hear. Basically, this resulted in, as you said, a report at the beginning of the spring this year, but also we had issued a position paper together with the French authority, and we gave some feedback, of course, also on EU proposals. In doing so, we found, and that's something which is, I think, common knowledge in the meantime. We defined a specific definition of sustainable bonds yet. So in our report, our exploration, we looked at every bond which was called sustainable in a way, so including green, including social, including sustainability, including impact bonds, blue bonds, SDG bonds, and other similarly labeled bonds. And if you then looked at that market grew very rapidly in Europe, but also very much so in the Netherlands, which is under our supervision. So we focused primarily on the Netherlands. As you can see in the slide, the market started around 2013 and then grew very fast. In fact, in 2018, the issued amount already was 9 billion of total sustainable bonds, and that doubled, in fact, in 2019, which was partly, of course, driven by the first issue of the Dutch state, the first green bond that they issued. I haven't included the figures for 2020, but we think that there's even a further rise this year, but that maybe you know better than we do. We've seen between 2014 and 1970 sustainable bonds issued in the Netherlands. That means that we also had to issue a prospectus, which we had to look at. But even that figure, so we have around 44 billion euros issued so far until 2019. This still is only 4% of the total Dutch bond market. So there is, in our view, still sufficient room for growth in that respect. And we indeed think, and that's also came also from the talks that we had with market participants, this growth is going to continue. And there are, in our view, 4 main reasons. In general, of course, we see the whole economy transitioning to more sustainable economy. And that's also a societal thing, but also the science. There's large investments needed. We see the European Commission, for instance, estimating that around 260 billion a year would be needed, and that will, to some extent, of course, be financed with bonds, with green or sustainable bonds. We see from your side in particular, of course, much more demand from investors. Asset managers, insurers, reinsurers, pension funds, banks, they're all wanting to reallocate larger portions of their investment portfolio to an increasing portion of sustainable investments. But we also see that from the private investors increasingly through funds. And finally, of course, also the issuers are making a move. We spoke to a few issuing companies also with sustainable bonds, and they also increasingly finance their investments, particularly if they consider them sustainable, through sustainable bonds. So these points together would make us expect that this market will still continue to rise. Then what we also noticed, and that's of course one of the features of a small, at the moment still relatively small market and a new market, that there was not a real standardization of different aspects of this market. And we think that the importance of transparency and standardization is therefore very important to have a good and stable growth of this market. In fact, there was not yet a clear standard that a sustainable bond has to meet. We've seen a few leading frameworks, of course, from ICMA and CBI, but still there are also others, and there are also still some divergence in those areas, particularly regarding taxonomies. So some diversity and the voluntary nature also of the frameworks can create some challenges for investors. Secondly, all these things also have still a risk of greenwashing or social washing or impact washing, whatever you call it. And we think that getting more objective criteria, more standardization would help to reduce such risks, both for issuers and for investors. And as an example, the current EU Green Bond Standard, which is being consulted, could be a good step in that direction, because in combination with the proposed EU taxonomy, it will help to limit those risks and also to stimulate this market. A fourth element we saw is the increasing importance of ESG ratings, and we see that even also there we see quite some divergence in terminology, but also in methodologies. So also there, I think some more standardization could be helpful for both issuers and for investors. Also, the external review services use different approaches. We see different firms providing such review services, and an example of how that could even be better is in our view, what's proposed in the EU Green Bond Standard, to come to some kind of a standardized verification program, so that also everybody knows what the verification indeed states. And finally, reporting on non-financial information by issuers is also something which is under our remit and where we have a look at. And our team who's looking at this issues an annual report about their findings, and the last one in December 2019 stated that it's increasing, it's becoming better and better, the non-financial information, but it could still be a bit more specific, for instance, on the impact on climate change. So these were some findings that we saw in our exploration. One element I talked about, and that's probably familiar for all of you, is already the Green Bond Standard by the EU, which, as stated, there's consultation going on from the European Commission until 2 October. And then I think in the fourth quarter, the European Commission will decide how to take this further. As stated, we consider it an interesting development. what's particularly new is in fact that under this standard, there would also be the connection to the European taxonomy in a green bond standard, and also the annual allocation report and the impact report, which is now more of an obligation rather than just a voluntary way. So, and still this green bond is considered to be a voluntary standard, but you're only allowed then to issue a green bond and call it the EU green bond if you adhere to all the obligations which are specified here. A last element that we looked at for ourselves, for the AFM supervision, what does it mean for us internally? There are a few areas where we have a role. Most importantly, I think in the prospectus area, where we have to look at the prospectuses that are submitted for approval to go to market, where we are looking, our team is looking at striving to have more transparency concerning the use of proceeds and allocation impact reporting. So in fact, what they do is they ask a few more questions normally than they would have been doing before. Also, what they are looking at is looking at advertisements, so that they are not different from what's mentioned in the prospectus. A second element where we are looking at is non-financial information in the management reports of large listed companies. We encourage integrated reporting, and that's something we also see increasingly, but we're also in constant discussion with listed companies to try to get the information a bit more relevant material, so that it's not just gold plating, but that it's really talking about the relevant elements. Regarding inside information, our team also is looking at timely disclosure of inside information, and we see, of course, that increasingly elements about sustainability become more and more important for companies. So that also could have an effect on their inside information obligations. And finally, we also are involved in giving feedback on new regulatory developments, like I said, the EU consultation on the Green Bond Standard, but also other ones. And we also contribute to ESMA, which ESMA is the European and IOSCO is the worldwide organization of supervisors. So we also can be a bit more vocal in those gremiums to support the further growth of a good sustainable market. Basically, that was a quick overview of what we have been doing and how the AFM at the moment is looking at this sustainable bond market, and we still adhere to our findings that it's a very interesting and fast-growing market which is getting more and more mature and more, hopefully also more transparent and standardized. Thank you very much.
Thanks, Jurgen. I will interrupt you on the questions right now, and actually, as we've decided, we are going to move to the next speaker. I'm trying to have a conversation with the three of you and the rest of the audience just after that. So keep asking questions to myself, and I will collect all of them, and we're going to go back to that in a couple of minutes after the two of our presentation. So I would love to call Adrie Heinsbroek from NNIP, who's going to join us to speak actually about green bonds and greenwashing. Adrie is principal responsible at NNIP and within the innovation and responsible investing platform. He works towards further integration of the sustainability factors into the investment decision-making process. And he's been quite active in green bonds and every social bonds where NNIP has been involved as an investor. Prior to join NNIP, he was head of sustainability at ING Bank in Belgium. So Adrie, I'll leave it to you, and we're looking forward to hear your presentation on green bond and actually greenwashing.
Okay. Thank you so much, Sophie. And I guess it's all visible and hearable. Otherwise, I will see people wave. But for now, until thumbs up. So let's go. And it's interesting to do this. This is my pleasure to share with you exactly what Jurgen from the AFM was just saying. It was all about, the market and the correct info, and also how the AFM looks at things. And I'm here to share with you a bit how we try to, I made a lot of provocative title, prevent greenwashing with green bonds. It is much more on, maybe not on information, but on correct doing. So allow me, and then I'm checking if I can go to the next slide. Yeah, it's going very fast. I want to share with you just one slide on our approach. How does green bonds fit in, so to speak, the whole idea of NNIP? It's part of our responsible investing framework, and we have two important investment framework beliefs for responsible investing: put your capital to work and improving returns. And doesn't surprise you, green bonds fit in both, but it's much more about that. It's part of our integral way of looking at investments. So not bothering you too much with this commercial advertising. How does this all works in what we do? So at NNIP, we made a categorization of our funds, which is not the same as the EU classification. As we probably, many of you know, you have to classify your products according to some articles by the EU, but we had already for years our own categorization. And green bond strategy is on the far right, an impact strategy. So it also says internally on some criteria. This also means a bit what Jurgen was saying. So we have to disclose certain information, report, both voluntary, but also because we think this is the right way forward. But how do you do that if, in a sense, you have a green bond strategy? So I am now looking exactly on how to do that. So I want to share with you some insights on the practicalities. So what we do is looking at green bonds, and it's an assessment of both the issuer as a company or an association, and the issuance itself. So exactly where do you need the proceeds for? It collides quite well with what Jurgen was stating. So there we need to see that the portfolio manager is making choices. He or she, in our team, it is a combined woman and a man. So how they select those issuers for their fund, and how can they comply with all the rules to make sure that there's a sort of proper interaction. I think that's the key of my presentation. There is an interaction between that team and the responsible investing team, so the team where I'm part of. And we have set for ourselves two sets of guideways. One is the business relevance, and the other one is the business model. And it sounds a bit of the same thing, but what we do is looking at, for instance, with the green bonds, what's the proceeds going to? Which SDGs are reflected with it? So we are also sort of checking or having an additional view on, is this being correctly mapped? Is it correctly being ticking the boxes? Because a portfolio manager could maybe on a certain moment think, yeah, that fits perfectly in my reporting or in things that I need to do. So how does it work? So on the business relevance, combining this with the materiality framework. It's a bit of a word game, but therefore we say that the other thing is assessing the business model. So interesting enough, and I will show you later some examples, is that we try to do looking at what's the business model of the issuer, what's the type of company, and what is actually the type of activity supporting the business model of the issuer that the proceeds of this green bond is being used for. And therefore, dialogue is extremely important. In a sense, fixed income is sometimes more difficult maybe, but on the other hand, I would argue it's less difficult. Every issuer of green bonds really actually likes to talk to you as an investor because they want to make and explain exactly their green bond. So this is the theory. So in that sense, we really look at the business activities, not just only prospectus and all the things. So what is really going on and how do we assess this? Then talking about the title of my presentation, how to ensure that it's green, or that how can we have proper governance. So we had a sort of green bond, we said a green bond governance work stream in there. And that work stream is actually looking much more to how the three-step approach by the portfolio managers is being executed. So it's not like risk management or compliance, but it's much more as a business partner working with them and looking at them. So these are the three steps approach handed over and used by our portfolio managers. Both is it adhered to the Green Bond principles? What are the sector and project criteria? And additionally, the issuer assessment, including what I said about business model dependency and dialogue with issuers. So interesting enough, this is sort of the framework used internally. And then I come into play, because this is maybe the slide. What would be the key takeaway of this short explanation is that after that, we have the responsible investing team in the middle, where you can see it, that we have every month, at the end of the month, and Sophie said already it's a special day today, but on the other hand, this is also one of the last days of the week. So I got this morning again the email of the Green Bond team. These are the green bonds we tagged as green this month, and these are the ones we didn't tag as green. So we cover the whole green market issuance. Can you agree? That's in a nutshell the request. So there we come into play. So that means I have a certain amount of hours, or in this time, because it's Friday, I have to report back on Monday if we as RI team can agree with the selection. So we do this on a monthly basis. And on a quarterly basis, we do an additional review combined with the team. So we sit down together and we discuss a few of the green bonds, also monitoring. How are the proceeds? What about the reporting? Why is this so important? Because if we really want to make sure that green bonds are seen as green bonds and that it fits with the character of the portfolio, you have sometimes they have a sort of independent view on certain things, or certain companies can change their business model, or certain countries can have maybe a different government and then have a different view on energy transition. So maybe a green bond they issued 4 years ago could maybe not be as applicable as green bond based on the new ideas of the government. Why do I make this point? It is, I think, very important to ensure the green credentials of your fund. And I think especially, and that's my view, if you have a sort of high impact fund, you should be damn sure, that this fits within the color of your fund. So what we also have is the ad hoc consultation with the green bond team. It goes two ways. Either we walk over to them or the other way around. So it is a sort of continuous process, exchanging views. I think this is something that is not being taken. You cannot put that directly maybe in legislation or in rules. So as the AFM was saying, we have to look closely at certain things, but you could also say that maybe fund managers themselves should also be very well aware of things, these things, and put proper internal checks and balances into place. And then afterwards, of course, we have the external verification. But as we are in the middle, we are independent of the portfolio managers. We can have a say. And in the end, finally, we have to agree with their classification. So in that sense, we also have some influence. This is the theory. And also, now I want to share with you two examples. Two examples who didn't make it, and also to ensure business model dependency. I think most investors in the Netherlands were very happy that our national airport Schiphol brought a green bond to the market, and we actually said it's not green. So here, one of the examples, and I'm sharing here within the CFA Society Netherlands VBA, we are amongst practitioners, so let us be very bit clear and open and transparent to each other. This, of course, was also part of a conversation internally. It's an interesting bond, interesting issuer, and yes, I do take the plane also on occasions, at least last year I did. So we make use of it, but still we think it's not good enough to be classified as a green bond because of business model dependency. The idea of Schiphol is not to diminish CO2 emissions, it's not about eco-efficiency. No, the purpose of Schiphol is flying and growth of flying. So it's a bit of a difficulty in the purpose of a green bond, in our view. So this is one of the things that came out of the conversation. Another one, and of course you can disagree with this, but this is the way how we looked at things. Oh, and another one is Queensland, Australia. And that has maybe not to do with business model dependency, but much more, also an interesting example of the government. And we also talked to some representative of Queensland. They are now making sure that some mining corporations do a lot of thermal coal things in that part of Australia. And we have, as a company, also a policy on thermal coal mining. So adding 1 + 1 combined, for portfolio managers, sometimes these combinations, so this is the point I also want to raise, difficult to maybe. That's why the RI team and our governance work stream comes in, to make sure that we connect the dots and have a conversation with the portfolio managers. And indeed, and if you read very well, you see a typo on the last sentence of the slide. So it is, to fight climate change, indeed a weak case. So in our view, we should not consider this green bond of that specific part of the country as a green bond, according to how we look at things. Its interpretation, it's maybe subjective, but the thing is, and I want to stress that also, is that it made sure that internally we had very good conversation about the topic. So I think also my role is being part of the RI team, steering up not the debate, but making sure that people are aware of a lot of things to make really good decisions, which are aligned with the characteristics and the aim of the specific fund. I think this is what I would like to share. It is an example. It's a way of how we put things into place, to not being from a regulator's perspective, but much more internally perspective, to make sure that we are addressing this topic in a proper way. Sophie, over to you.
Thank you, Adrie. I'm really excited about our future conversation on the question, because a lot of questions come in already. So I think before we go into answering some of them, and keep sending them, please, I'd like to move to Chris, actually. Chris Wigley, which is joining us from the UK. And Chris is a very experienced fixed income fund manager. He's been, working for a number of different organizations, from Mitsui Bank, from Epworth Investment Management, or Mihova. But most importantly, what is the reason why we invited Chris to join us today is he's really one of the biggest specialists, I would say, in green bond, but also in social bonds. And we, he's been also a consultant for the PRI already back in 2013, where he helped on writing the first report on corporate bonds and how to integrate ESG. And he is very relevant for us today. He's been a member of the Green Bond Principal Executive Committee from 2014 until 2019, where he's really helped to have the organization, developing further the green bond to the social bond principle. Chris, I'm going to say it, but you've been voted the most impressive green SRI investors by Global Capital magazine in 2016, 2017, and 2018. So I know you, as a British citizen, you usually don't like this kind of compliment. And Dutch, we also like to stay low key, but I want to mention that. So anyway, under further view, I would love to give the word to Chris, who's going to really take us to, not only after talking about the green, but about the social and the COVID bonds. And afterward, I would love to open the forum to question and answer. Chris, your words. It's your turn.
Okay, thank you very much indeed for that introduction, Sophie, and hopefully you can hear me okay. And first of all, everyone, let me apologize for being overdressed. I do assure you that I feel much more comfortable in an open neck shirt. So if you ever did invite me back, I assure you I would dress more comfortably. I'll share my presentation with you. So bear with me. Okay. Okay, so again, thank you very much indeed for the invitation to speak to you. Today, I'm going to talk about COVID-19 social bonds, and I'll also touch on COVID-19 sustainability bonds as well, and I'll explain a little bit more later on. And I've been asked to speak for about 25 minutes, and I hope I can interest you in this exciting new product. So today, I'm going to talk about social bonds, the market history going back to 2006, and then talk about the profile of the COVID-19 social bond market as it is now, and then a few examples, and then talk a little bit about social bonds and what I think we may see in the future as well. So what is a social bond? Well, of course, it's very simply a social bond will fund projects in healthcare or education, access to water, better sanitation, particularly in developing countries, affordable housing, employment generation, and empowerment. Now, multilateral development banks who've been active in the space and corporate social bonds, they're regulated in the same way as conventional multilateral banks and corporate securities. However, to reassure investors and to reduce the risk of social washing, social bond issuers may choose to follow the social bond principles. So what are the social bond principles? I'm sure you're aware of the green bond principles. They're very similar. The Secretariat is the International Capital Markets Association, and the Executive Committee has 24 members, the same members as for the green bond principles. And there are 3 types of member issuers, banks, and investors. With 24 members, that's 8 of each, and it includes the EIB, Nordic Investment Bank, Iberdrola, on the bank side, JP Morgan, ING, SEB, and on the investor side, Zurich Insurance, Action, BlackRock, and others. So 24 in total. These are the market professionals who are in the market on a daily basis in social bonds and green bonds. So they're specialists and they use their expertise, they pool their knowledge, they work collaboratively to develop the green bond market and the social bond market. So just moving on to definitions, and please bear with me here, I've got a couple of slides. The definitions from ICMA for the first 3 types of bond is that for a green bond, of course, it funds 100% green projects, so green bond principle aligned. For the social bonds, they fund 100% social projects, so social bond principle aligned. Now, in the case of sustainability bonds, as defined by the ICMA, there are some issuers who have green projects and they have social projects, so they can use a mix of the 2. But at the same time, the proceeds from the bonds, 100% of them must go to green and social projects. So they are the definitions from the ICMA on green bonds, social bonds, and sustainability bonds. Now, I've added a 4th one here called responsible bond, just to highlight one thing, and that is that we have had sustainable bond funds around for at least 20 years. They predate the green bond, social bond, and sustainability bond market, which were really launched in 2006 and 2007. So what were these sustainable bond funds investing in prior to 2006? Well, very simply, they were investing in conventional bonds with high ESG ratings. So, for example, maybe Iberdrola, with a high ESG rating from the likes of MSCI or ARIS, for example. So it's useful to have a term for these bonds as well. But I think as an industry, we need to work out our definitions. So in the future, what do we call a sustainable bond? Is it a conventional bond with high ESG ratings? Or does sustainable bond refer to the whole range of green bonds, social bonds, sustainability bonds, etc.? I think that's some discussion that we need to have within the industry for clarity. So just moving on, all part of the definitions of a social bond. So this is what the social bond principles say. These are the 4 mandatory elements. So of course, disclosure of the use of proceeds, transparency, this is the cornerstone of the social bond principles. Investors want to know how their money is going to be used. And similarly, 100% needs to be allocated to projects. So 50% is not good enough, even 95% is not good enough. If it's 95%, it's not a social bond. It has to be 100%. Additionally, and it doesn't state this in the principles, but it's implied, there has to be a roadshow social bond pack or social bond framework. Because the use of proceeds have to be known, there has to be disclosure, and it has to be disclosed in some way. So if the social bond is the first social bond, there may be a roadshow social bond pack, or if there's expected to be a whole series of social bonds from the same issuer, then there will be a social bond framework which will relate to all those social bonds. And then finally, regular reporting. This is important. So Investors will want to know, and they're often advised annually, about the allocation of funds to projects and also the progress on the projects themselves. And increasingly, this is impact metrics as well. So these are the things that social bonds provide that conventional bonds do not provide. Just moving on, I'll just touch on verification very briefly. So there are external reviewers in the social bond market in the same way as there are in the green bond market. For example, Sustainalytics, Cicero, Visuaris, DNV, KPMG, etc. And their job is at least twofold. So one is they're employed by the issuers of the bonds to advise them on how if investors may regard the social projects proposed. But also they will produce a short report as well for investors, giving their opinion on the bond. Now, large institutional investors, such as NNIP, for example, will have their ESG analysts. They will have a large team to analyze each bond, and so they wouldn't rely on these opinions. However, smaller investors who don't have the resources to have an ESG analyst may well appreciate these short reports from the external reviewers. So just looking at the history of social bonds go back to 2006. This was the first social bond ever issued. It was by the International Financing Facility for Immunization, or IFIM, and they raised money for an immunization program for children in Africa. It was actually to fight malaria. But this is the first time that an issuer disclosed the use of proceeds, and it became the template for the first green bond in 2007. But of course, the green bond market took off exponentially, social bonds a little bit slower. But we've seen significant issuance in social bonds since 2006, for example, from African Development Bank. BNG have been an early issuer, particularly sustainability bonds, City of Madrid, Danone, Deutsche Credit Bank, and NWB. Actually, NWB has made a very important contribution to the development of the social bond market, in my opinion. And I'll say a little bit more about that in a minute. In terms of issuance, from 2016, 2 billion. This looks quite small, but it is growing. And you can see in 2020, we've had at least 30 billion or so. So it's really taken off. And this is just social bonds. There's also sustainability bonds in addition to this. So I touched on NWB before. They were an example of an issuer before COVID-19. They first issued a social bond in 2017. They're an important issuer in social bonds. They've issued 9 social bonds to date, amounting to 6.7 billion. They've actually issued at least 4 social bonds in excess of 1 billion euros. So they've greatly helped the liquidity of the social bond market. And the use of proceeds, of course, was to fund affordable housing, and they do regularly report as an annual newsletter on their website. So turning now to COVID-19 social bonds, in March 2020, I was getting concerned about COVID-19, and I wrote an article in Responsible Investor about how I felt social bonds could be part of the solution. And I was pleased to see multilateral development banks and others come to the market and issue COVID-19 response bonds. And I felt there were 4 priorities. So first of all, addressing healthcare issues. Secondly, business continuity between the waves. A vaccine, of course, at scale and at speed. And then, of course, an economic recovery. We all know that the financial crisis was bad, but the drop-off in GDP this time around is even worse. We need to grow out of this situation. So a quick look at the profile of the market. So since March 2020, we've seen up to $100 billion of COVID-19 response bonds. So up to about 60 issues, which I think is quite impressive. Here we've got what I call standard bonds. These are the bonds that meet the social bond principles or the sustainability bond guidance. So 70% of the issues meet those standards. And of those, 59% are social bonds, 41% are sustainability bonds. At the moment, none are green bonds to fight COVID-19, but watch this space. I'll try and say a little bit about that a little bit later on. So a bit more on the profile of what we call GSS bonds, or green, social and sustainability. So 42% currently in dollars, 51% in euros. It used to be dollars were dominant, but we've seen a lot of issuance in euros more recently. Again, supranationals are dominant at 49%, but more recently we've seen more issues from government-supported entities, for example, ECO of Spain and Industrial Bank of Korea, for example. And corporates have issued also too. Also, AAA is quite dominant, but again, we're having other credit ratings issue also. The market is actually following the same pattern as the green bond market at the beginning. At the beginning of the green bond market, it was very much dominated by multilateral development banks, AAA, and focused in the 1 to 3 year sector. But it matured beyond that. However, I would say that the social bond market has done the same thing as the green bond market, but in a much shorter space of time. When the green bond indices were launched in 2014, there were only about 40 or so issues in the index, and already you've seen here, there's 50 to 60 social bonds. So we've made as much progress in the COVID-19 social bond market in 6 months as the green bond market did in the first 6 years. I think that's significant. And we're seeing issuance across the maturity range, 3 to 5 years, 5 to 10 years, and quite a bit of issuance beyond 10 years as well. So what's the money being used for? This is my analysis. So this is based on the social bond framework. So we have 29% to employment generation, so all part of economic recovery. 26% to SME lending, that's all to do with business continuity. Access to essential services, this is particularly for developing countries. But we also have to bear in mind that some of these frameworks were written prior to COVID-19. So issuers have used those frameworks, but they weren't written specifically to address COVID-19, but they were written to address these social issues. Healthcare support, 12%, of course. Economic support, again, 10%, all part of economic recovery. And of course, affordable housing. So unfortunately, as more people lose their jobs, etc., more people are in need of housing support, etc. So just to look at 3 examples, I have here CAF, which is the Latin American Development Bank. They issued a 700 million deal in euros. It was for emergency economic support, but it was also for healthcare support. And I really liked their outline of projects in terms of healthcare support. So it was for the manufacture, for example, of medical supplies. It was for virus testing specifically. It was for the expansion of labs. It was for R&D into vaccines, for example. And also it was for education and mental health support as well in relation to COVID-19. So I thought that was a very good example in terms of healthcare support. Another example is the Ford Foundation. And this really addresses, we talked before about business interruption. Well, this is addressing what they call as mission disruption. So of course, it's also the non-profit sector that is affected as well. And I liked what they wrote here, that the foundation's target population are particularly vulnerable to operational, employment and mission disruption as a result of the wider economic slowdown caused by COVID-19 control measures. So there's a real recognition here, recognition of the threats. And what Ford are doing here is they're borrowing from the markets so they can increase the number of grants that they make to minimize that disruption as much as they can. So again, I thought this is a good example in terms of helping business continuity, non-profit continuity as well. And then the final example is African Development Bank. This was an early issue back in March, April of this year. And it really represents an issue that's particularly trying to address economic recovery. So they want the bonds to help alleviate the economic and social impact of COVID-19 pandemic, will have on livelihoods and Africa's economies as well. And I thought it was good that very early on they recognized that globally factories have been closed and workers sent home, disrupting supply chains, trade, travel, and driving many economies towards recession. So again, this is an example of a COVID-19 bond looking to help in terms of economic recovery. So just looking at the future now then, so what are the solutions? The solutions can be government-led, or indeed it could be EU-led. They could be charity-led, as in the case of the Ford Foundation, and they can be corporate-led in the case of, for example, banks. We've had banks issue COVID-19 bonds such as BBVA and Mitsubishi Bank and others. And of course, as you know, that part of the solution can be green bonds, funding green infrastructure and green jobs. But please, it's not all about that. Climate change is very important, but there's more we can do in terms of social activity as well. There's possibly social infrastructure to be built and skills and health as well. So there's another dimension here to help with the economic recovery. So as we said before, there's the potential there for green growth. I'm sure you know, you're very familiar with green bonds and you know the sort of projects that can be funded, such as electric vehicle charging points and hydrogen vehicles, coastal and flood defences and biodiversity protection. They're all underrepresented and they need finance. But it's not just green growth, it's also social growth as well. So these are the opportunities. These are the projects that social bonds can fund. They can fund the expansion of healthcare facilities. They can fund more healthcare support. And please bear in mind, I don't know if any of you are on the issuer side of things or on the underwriting side of things, but please don't underestimate the importance of mental health. We have families who have maybe lost loved ones or may fear losing loved ones. We have individuals who have maybe lost jobs or fear losing jobs, and lockdown itself has its own stresses and strains too. So this area, I think, it shouldn't be underestimated in terms of importance. Plus, we have access to education, and vocational training is very important for employment generation. Employment support, of course, and affordable housing we mentioned before. Digital technologies, broadband, providing broadband to children who are not able to go to school for the time being, or for individuals who need to work from home. And also for empowerment as well. So as we try to build back better, this is an opportunity to address some of the social injustices and inequalities too. I thought it might be of interest just to have a look at the social impact metrics of social bonds. For me, this is an underdeveloped area. This is just a snapshot of where we are at the moment. So green impact metrics are pretty well advanced and developed in terms of CO2 emissions, etc., but less so in terms of social impact. So social impact metrics tend to be focused on populations, and I've just got here a few examples. So for example, in health, it could be the number of children vaccinated. At the same time, it could be the number of beds created as well. In education, it could be the number of vulnerable students helped, or it could be the increase in textbooks. In water, it could be the number of new household connections, or it could be the provision of better sanitation. Employment generation, of course, loans to SMEs, or it could be the number of disabled people who are supported. We talked about affordable housing earlier and the number of dwellings, access to technology, the number of first-time connections. Empowerment, again, the number of loans to women-owned SMEs or to microfinance in the developing world, for example. So there's huge opportunities here and a lot of scope for development, particularly in social impact metrics. We're at quite a primitive stage really here, and I think this needs a lot more development. And then finally, just to look at what may be in the pipeline in the social bond market, what we can expect over the next few months. There are some significant potential issuers of social bonds. The European Stability Mechanism has said they will want to issue social bonds, and they've already written their social bond framework. AFD in France have said that they want to issue. banks, of course, during this COVID-19 crisis, it's the banks who have been lending to SMEs, so they can be used as projects for social bonds, following the likes of BBVA, Mitsubishi Bank, Kookmin Bank in Korea, etc. And many others could potentially issue. And of course, there's the European Union as well. We know about the SURE program, and they have said that they are looking at issuing social bonds in line with the social bond principles. And of course, as you know, they've said that they hope to issue about 30% of the program in green bonds as well. So that would be over 200 billion euros or so. So this is significant. And it's good to see the EU having a recovery plan to address this terrible crisis. So that's just it, a snapshot really of the COVID-19 social and sustainability bond market. As I say, I feel there's tremendous potential here along with green bonds. Thank you.
Thank you very much, thank Chris for this very, very helpful presentation. So I must admit I got a lot of different questions from all over the place, and I'm going to try to structure that for the three of our speakers. Question came from a lot of different areas, from the regulation, from the definition and standard of all different type of bonds. So I think we're also going to discuss that type of, difference between social, green, even to blue bonds. So let's go there in a minute. Impact measurement and verification, we had numbers of questions there, and also on the impact reporting. But one question came in, which for me was quite interesting. We're obviously talking about the sustainability part, but I think, Kim Finn, you've been quite vocal on that, which is about the pricing of this bond. So your question was about, how would green bond be priced on the curve? So really on the green bond pricing, look some of the Dutch green bonds, which has been traded 3 to 4 basis points through the curve. So if maybe started with Adrie, I think, on the green bond pricing, if you could make some comment, how should they be priced? But also after that, I would love to have some comment from maybe Chris on the social bond. If you could tell us something about how the pricing, because these bonds have been quite oversubscribed, but how was the pricing? So Adrie, can you make a comment on that first? How?
Actually, I wanted to use my disclaimer for not being a portfolio manager saying something difficult to say something about pricing, but let's again, we are all practitioners, so let's share something. How they should be priced, I think that's a very theoretical and philosophical question. What I do think is that the price, just like with regular investments compared to sustainable investments, we should have the same risk-return profile. We should have the same way of doing it in the market, and not a preferential treatment. And in a sense, you could also say, do they need a premium? No, they need to be. They don't need to be. But the interesting thing is, they should be competitively priced, and because otherwise you would say. We get less return, because if the price is higher and the interest rate, that's not going to work at the end. So let them just be part of regular pricing, regular market incentives, because that's the only way really forward for this type of bonds. If you see how the prices are developing, it's not very bad to be invested in green bonds currently. Is this answering your question a bit, Sophie?
I'm going to move to Chris, but I would also encourage the audience to step in on that question, because I think this is quite an important point, which we didn't touch too much on. Chris, any comment from your side of what you've seen happening?
Yes, certainly. So thank you. So I'd agree with Adrie in that it's important to really look at the credit of the bond. If the issuer of the bond, say a green bond, issues also conventional bonds, then the yield, the credit risk is the same and the credit rating is the same. And as an investor, I would say then the yield and the credit spread should be the same as well. Of course, as investors, we have a fiduciary duty to our clients to get the best return that we can. Just some observations about pricing in the green bond market. I would split it into two. So we've got the secondary market and we've got the primary market. And in the secondary market, my experience is that the green bonds may trade at maybe a 1 or 2 basis point premium or discount to the conventional equivalent from the same issuer. And for me, a good portfolio manager will be selling the ones that are 1 or 2 basis points more expensive, and then switching into the issues that are 1 or 2 basis points more attractive. That's my experience of the secondary market. So it's just short-term supply and demand pressures there. In the primary markets, as I'm sure market participants know, in the US Treasury market, for example, when the US Treasury comes to the market with a new 5-year issue, how are they going to incentivize the market to buy it when the market already owns a 5-year Treasury? So they offer what's called a concession. So the yield will be slightly higher. And it's the same in the primary market for corporate bonds. There is what's called the new issue premium. So this is the premium the issuer pays. So it should be higher than the secondary market. Now, the next question is to what degree should that premium be? Some cases, it can be up to 20 basis points or so during the volatility in March and April. I'm not talking about social bonds or green bonds here, but for the market generally, for emerging market debt, it was much more than 20 basis points. So it varies according to market conditions. But I think investors have to have a clear view of what sort of yield they expect with a new green bond or social bond. But certainly as an investor, we have a duty not to pay an expensive price for a social or green bond.
Please unmute yourself. Assuming that technology was just a try. If you want it, just raise your hand. I think there's a button or so you can raise your hand where we can work with that. I have a whole numbers of questions on, should only green company be allowed to issue green and social bonds? And would you actually consider investing in a green bond issued by an oil company, as an example? So that's a general question I get. Some additional question coming from some of the participants about, actually news in the media of, I think this was another one from an NIP about selling the Polish green bonds this morning, announcing selling green bond this morning. But how did that bond came in the portfolio maybe before would be the question. So I think this is quite interesting for us to discuss. Should we invest in a green bond issued by a bad company? And who wants to start with this answer?
Shall I just set out the case as I see it? I think with regards to, say, an oil company issuing a green bond, I hope you can hear me okay without too much background noise. So there's 2 ways of approaching an oil company issuing a green bond. On the one hand, one type investor may say, I don't want to invest in this green bond from an oil company because I don't want to prolong the life of this fossil fuel company. And additionally, the investor may say, as it's a company in fossil fuels, that may well be a significant financial risk for me down the road, maybe 10 or 20 years' time. We don't know if it's still going to exist as an entity or in the same form. So I find some investors take that view. There are other investors who take another view, and they would say that they would invest in a green bond issued by an oil company because it's a green bond, it discloses the use of proceeds, and the oil company is saying 100% of the proceeds are going to go to, for example, renewable energy projects. So that one investor may take the view that this is going to encourage the oil company to transition, to become more sustainable, and that should be encouraged. So there's one group of investors who would invest, and there's another set that would not. I myself, I would belong to the second group. I would like to try and encourage that oil company to transition.
So you were saying that actually there are a different shade of bonds. You know, you mentioned the kind of transition bonds actually in your conversation, and that each investors can actually set their own standards. But in that case, is a transition bond, so a bond from a company which may not be a good company, but we're trying to support transition, is it actually, for our definition, a social bond?
So,
Sorry, in the case of the transition.
just to develop things a little bit more, of course, there are, in part of the analysis of a green bond or a social bond, it's important to not just look at the bond, but to look at the issuer as well. So I can cite an example perhaps of a Korean utility that issued a green bond, and the money was going to be used for green projects, which is fine. However, the parent of the utility had a very poor record in terms of safety and corruption and governance, and they were also involved in nuclear as well. And an investor may take the view that that's a dangerous combination of being involved in nuclear energy and corruption as well, in which case, irrespective of the green projects that were funded, you know, this would not be an eligible investment. But it is important to not just look at the projects as well, but also to look at the issuer and the parent of the issuer also.
And if I may add, because in that sense, I politely disagree a bit with you, Chris, is that it depends indeed. Every company can or should be able to issue a green bond, and it's up to the investor to select does it fit with the characteristics of my fund and where I want to put my capital to work. And in that sense, it allows you to have a conversation with some fossil fuel companies. But no, I think for a real green bonds, I think you should be a bit more strict and say, well, this is not going to happen. And indeed, on the transparency, yes, we did own the Polish government green bond, so as we do the Belgian one, for instance. And why did we start with it, and why have we then on a certain moment no longer have it in the portfolio, is that governments can change in strategy, same as companies also change in strategy. So on a certain moment when you do not see that it's really going into that direction, the real transition, or just a one-time issuer for a one-time topic, and for the rest nothing's really going to change, that's more difficult. Currently, I do see, by the way, the Polish government taking a more pro-renewables approach again. So it's quite difficult there. Saying that, having said that, I do think that companies, just like what Chris in a sense said, if they issue a thing on a transition and make the energy transition, it also should be really, really part of that company's strategy, and not just a one-time issuer on a certain issuance on a certain topic. So we think, and that's again in my presentation, the conversation between the portfolio managers and us as RI team, who has a bit of the, I sometimes feel like I have to protect the green credentials of our responsible investing approach, sometimes have this sort of tough discussions like we had with Schiphol, or for instance on the Polish government. But for the rest, I do think things sort them out a bit themselves. It's not completely like Harry Potter and the sorter hat, but things sort them out a bit by themselves, in my view.
Any participant would like to add something on that? Any view? I'm going to keep asking.
I would like to add something. The decision whether you, as a green bond investor, should invest in an oil company, I think you also should try to incorporate the hassle you get with a lot of other stakeholders. Because if you're really a green investor, time over and over again, you will have to explain why you have invested 1 year ago, 2 years ago in that oil company who's still using fossil fuels. So if you are really a dedicated green investor, you should really consider that. If you have a more of a loose policy in which you are allowed to invest in oil company, that makes it easier. But again, I would like to add for my colleagues here in the Bond Commission to stress that you also have to take into account that reputational risk and the hassle you have to take onto you the load. You have to explain to your compliance department, the risk department, the regulators over and over again. And I don't want my colleagues to regret the decision that would I not have invested in that oil company for that 5 extra basis points.
If I allow me, Sophie, I like your comment. That's exactly a bit maybe the role that we have and that I have with one colleague of the RI team in challenging or bringing these topics to the minds of some of the portfolio managers. On the other hand, they are also not deaf and blind for the circumstances, and they have chosen to be a portfolio manager for green bond, so they know what the strategy stands for. So actually what you're saying is start with the beginning of what is the aim of your portfolio? What is the aim of your strategy? And then things sort out a bit themselves. And yes, I agree with you. Green bonds from oil companies on certain topics and oil companies that really have no real energy transition ambition should not be part of your things. And I do think in the next 2 years, this will become much more debated and discussed, because I do think, and I foresee that some oil companies, for a few companies, are really making steps to put CAPEX in a different way than what they did. So how do you deal with that? So that's an interesting outlook in my view.
I'd like to add something to that. I was looking at a bond the other day from Pfizer, who issued a 1.5 billion COVID bond, which was actually, with a lot of social bond and with a lot of eligible project described in the prospectus. But we also saw something in it that, let me get it right, the prospectus was say that before allocation, the funds might be temporarily be used for short-term investment or repay over borrowings. So it looks to me that they use that, prospectus to raise bond on the idea of a social bond, but actually if you get the money and you need it for something else, you can put it somewhere else. So would a bond like that suit a Dutch, institutional investors? Would that count as a SDG investment? So would love to answer that question.
Can I just add something here? So just going back on the previous discussion, there are some asset management houses where the ESG team will have a blanket policy on what may be eligible and what might not be eligible. So portfolio managers may not have total discretion. They may have total discretion if the ESG team think that a certain bond is eligible. But if the ESG team think a bond is not eligible, there's no way a portfolio manager can override it. So there are some safety mechanisms inbuilt. Just coming back to the point about Pfizer, you're right. I mean, I remember there was an issue coming out of Hong Kong a couple of years ago, and I don't think the issuer understood, and they wanted to perhaps use the bond for liability management purposes before they actually invested in green projects. So, of course, that bond would not be eligible for a lot of green bond investors. In the case of Pfizer, I think we need to be careful because there are some cases, and I'm not saying it's the case with Pfizer, but there are some cases where an issuer of a green bond will want to fund a green project, and they may well do fund that green project short term until they launch a green bond, which will fund it long term. And then as soon as the green bond's launched, then they will take the money and they will repay the short-term financing. So sometimes they do that, and for some investors that may be permissible, but it demonstrates you that for me, ESG analysis is very qualitative, and you have to look at every bond on a case-by-case basis without assuming too much. So we do have to do the analysis each time because it can be quite technical and quite intricate. That's my view.
Thank you. Anybody else would like to? So if nobody else wants to comment on that, would love to move maybe to a couple of other questions on. Maybe we're going to move a bit to the European regulation. Actually, I had some question on the regulation, but Jurgen, back to you. What's the trends here, and how does, for instance, the AFM will be part of the European Green Bond Standard consultation? So how does that fit? And if you could give us your perspective, how the regulator are working together towards an international cooperation towards more harmonization or not?
Yes, happily. As I said in my talk, there's quite some cooperation going on at the moment in ESMA and IOSCO. Those are the ESMA is a European group of supervisors on conduct, and IOSCO is on a global scale. So we see an increasing cooperation there, and we see that a few countries are leading the pack. So we see that particularly France, Sweden, but also the Netherlands, I think, are taking the lead there in talks, trying to be more positive and more prominent on this topic. So yes, there's quite some good connection there. On the prudential side, DNB, the Dutch Central Bank, is even more positive on this development, and as you've probably seen, they've been issuing quite some reports also a couple of years already about climate change and the impact on the prudential side of the financial sector. And recently they also have with the NGFS, there's also cooperation between all central banks across the world. They have also their leading role. So we see quite some, and that's partly, of course, because our investor sector is pretty extensive in the Netherlands. So it's an important sector for the Netherlands in total. So yes, there is quite some development, especially on the European side. I'm not so familiar with the US. They were always a bit lagging behind in this sphere. I'm not exactly sure if we see some changes there, not with the federal government, but also more on a regional level, on a state level. There's quite some positive impact.
If somebody has any comment to the community to bring regarding the US? Then I move to Chris on that question. If you could maybe give us a bit your view on the different social bond framework from country to country, because there's kind of different region, different frameworks going on. Could you give us a little bit, or actually, if you even have the green view too, feel free to, but definitely on the social bonds, would be really interesting to see what do you see happening.
Yes, it's quite interesting. So, of course, the bond frameworks are very important in terms of transparency and impact. And as I mentioned in my presentation, the market was really led by the US dollar bonds at the beginning of the COVID-19 crisis. But we've seen a lot of euro issuance subsequently. And I would say that perhaps the best quality frameworks I've seen have been European. They tend to be maybe 30 or 40 pages long, quite detailed, and often in PDF format, which is good to see. So lots of information provided. In the US, again, we have seen frameworks, which is good. But maybe they're a little bit shorter. Maybe they are just 3 to 6 pages long, but still in PDFs. So that's good. But then when we look to Asia, I would say they do produce frameworks. So they do meet the standards of the social bond principles and green bond principles, etc. But in the case of COVID-19 social bonds, sometimes those frameworks are just web pages, and that makes some investors a little bit uncomfortable because maybe that web page can disappear overnight, or maybe it can change. At least there's not as much information there as we would have in the US or Europe. So there's quite a contrast, and it echoes what we've seen in the green bond market. In terms of ESG analysis, we've had to do more analysis of emerging market green bonds because perhaps emerging market issuers haven't quite fully understood what is required. Sometimes there's a a lack of transparency or a lack of impact. But we hope that over time that more and more issuers will see what investors are looking for.
Kim Tin, I know you took the word in before. Do you have? I think you had a question for Chris on the, the European Pandemic Emergency Purchase Program. Do you want to ask it yourself?
Yes. The question is because I'm a bit confused about all the classifications, and know that the EU has announced that they will increase the Pandemic Emergency Purchase Program with 750 billion euros. Would they also qualify as social bonds?
So yes, this is very much a developing space. It is the latest news. So what we did hear was that they were considering issuing social bonds that would be consistent with the social bond principles. And then just in the last week, we've had an announcement that 30% of the funding program will be through green bonds. So perhaps their thinking is developing as it goes along. But I would say that social bonds certainly remain an option given the range of projects that can be funded.
Okay, thank you.
What I would love to discuss a bit is is the measurement. So measurement, I think it's quite keen, and in this whole area of greenwashing, impact washing, there's the intentionality, how good or bad the company is, but is it really something happening after that? So maybe Adrie, if you could start with what do you do or what you do practically in the measurement? You mentioned that a bit in your presentation. So what needs to happen from your point of view to improve that measurement part? Is there something we need to happen? And then Chris,
Okay, thank you for the question. It looks like an easy question, but it is not, because you're asking what should be improved.
Yeah.
And I do think that if you are able to make measurements and have to do all these things, like also was in the presentations, you have of course to have the disclosures of the companies, of the issuers. So I'm not talking about data in general, but companies should really be able to bring forward really interesting measurements potential. So now it's relatively easy. You read all the prospectus, you read the issue, you read the second party opinion, and you say, well, this maps according to certain SDGs. Then it just starts. What you need is in the next years to be much more able to specify, or even, and I think with green bonds it's relatively easy because it's about CO2 and about carbon and carbon avoided, but also there you can have discussion between carbon intensity and carbon footprint and all this stuff. So it is not that simple. What's needed is clear reporting or clear disclosures by the companies, and then we can do our own mathematics and our own calculations. So that could be improved. On the other hand, what we should improve, we as investor, maybe make it more insightful for the end investor. So what does it mean, the certain things? What does this portfolio do better on these type of measurements than the benchmark or another portfolio? Or do we see things change, or do we see over time maybe changes in policies of companies? So that is something that I also think, so that's the second thing what I'm going to see in the next couple of years. There will be some discussions and debates on that, and I also am looking forward to that, because that really will move a bit the needle, and that is in my view what's needed on this.
Thank you. Jurgen, you are the man next, absolutely, on my list. Please let us love to have your comment on this.
Yes, well, thanks for that. Yeah, indeed, I fully agree with what Adrie says about companies. We have a role there as well as AFN, and we're doing that as far as we can. So what we are doing in our supervision of financial reporting by listed companies in the Netherlands, we try to be very active also in terms of non-financial information, and that's what I told him in my talks before. We try to get those companies in such a state that they are giving more relevant, more material information about what they do in terms of controls on the climate, on social welfare, on corruption, anti-corruption, on these kind of elements when they talk about it. Especially the last report that we did about it last year, about the last financial reports, showed us that it was improving, but what we miss is the negative side. Typically, and that's almost human, they want to tell, of course, in their reports about how well they are doing in different areas, and that's fine. But when something doesn't go wrong, we sometimes miss that. So that's always two sides of the same spectrum, and also that is relevant for investors in the sense that you also want to know where things are not moving in the right direction. The difficulty is always that it's difficult to check indeed what they write. Is that correct? And we cannot really check that. And maybe there is, and that is an increasing element where we talk with the auditors, the accountants, to try to get some kind of assurance letters by the auditors that something which is written in the management report of a company about non-financial information, that there is some assurance that it's correct.
But Jurgen, this is exactly when I'm thinking about it. So is it not like the role, or I don't know if it's the role of the auditor, maybe also the role of regulator or government to trying to push, the market into verification about, and also making sure we have the right data and to also obliging companies to report on the negative and the positive impact of their action. And then that example of ESPON, do you see that as part of your role or the future going?
Yeah, to some extent, yes, we try to push both parties, so listed companies, but also the auditors to move towards more clarity, more assurance for the users of your reports, so the investors, in fact. But like I said, it's difficult for us and a bit less so, but also still for the auditors to really check if everything that a company writes down in a report is correct. But we also see that there still is a role for like independent journalists or NGOs or investors, of course, to ask also nasty questions sometimes to really check the companies about their plans. I mean, it's a bit in line with what Adrie said before about companies, brown companies issuing a green bond. It's fine as long as it's clear and clearly explained to what extent they really are, to what extent they are brown, and that they don't want to push that under the carpet, but to be as explicit about it as possible. And that's where we have a role.
Jurgen, if I may, but do you think that labels will then maybe also be interesting for that? So if certain funds get a label, or maybe the EU Eco label, but if that also gives maybe some credibility, what's your view on that?
Yeah, personally, I think that
personally
would help. I mean, I don't have the AFM policy on that. I don't know, but personally, I would say that it would help. Of course, like the energy label can help to some extent to know, well, are you in an A, B, C, D, E level? Of course, that would help in my view. But that's personal opinion.
Do we have any, I think what would be interesting for me is maybe, I think Wilfried, you are in this call, and I would love, I see you asking me a couple of questions already, which I've passed through, but I would love to have your view as an investor. Wilfried is with PGGM, and how do you see that part of the reporting, and how does it fit? How do you decide if that also this particular bond will fit your sustainable portfolio? Could we let you on the screen, if you don't mind?
Yeah, sure. I think my video should be on. And but let me start then by complimenting you and the rest of the speakers for the webinar, which has been quite interesting, especially in these times working from home. It feels a bit like we are really in one audience together today. So compliments, and also for Irma for organizing, and Olaf as well from Dutch Commission on Bonds taking the lead this time. Yeah, maybe on how we look at sustainable bonds then at PGGM. I think it's quite similar to what Adrie has been explaining for NNIP, only the color set is a bit different. At our place, it's green, whereas at NNIP, everything is orange in the slides. But the setup is quite similar. We have portfolio managers, of course, looking at the basis points, just like Chris also mentioned, 2 basis points for a portfolio manager might sound quite important, whereas for our responsible investment specialist, 2 basis points is next to nothing. And I'm a portfolio manager, so I care about 2 basis points, but I'm not the expert indeed on the responsible investment side. So we have a similar setup in the sense that if a new issuer, either from a green or social bond, comes to PGGM with the roadshow, I think Chris explained it quite neatly, that one of the advantages of this thematic bond market is that you actually get to speak to the issuer. So for every new issuer, and of course, I know it is because PGM is a big investor, but for every new issue, we get to speak to the issuer. And if we sit at that table, nowadays that's virtually, then we don't only speak to the treasurer, but we also speak to the responsible investment specialist. And similar on our side, it's not only myself on the table, but it's also our team member from the responsible investments team who's also sitting at the table. So the dialogue between issuers and investors is much broader than it was in the past. So that's a very useful advent, I guess, of this market. So what we do specifically, and might be a bit different maybe from NNIP then, is that we do focus on 4 thematic areas within PGGM. We have come up with those together with our clients in 2015. So we focus on food, on water, on healthcare, and on climate change. So every bond which focuses on these particular themes, that's first an investable theme. We have developed our own taxonomy back in the days, also together with APG on how we look at these particular issues and whether an investment falls within those categories and is indeed contributing towards a solution in one of those 4 areas. This was all predating, of course, the SDGs. So I think within 1 month's time, there will be a launch of our new sustainable framework at PGGM. This will be written in the language of SDGs, like the rest of the world, to create a uniform language to discuss these matters. But again, as I said, we are not the specialist as a portfolio manager. So also for new social or sustainability bonds, we have our own view on a framework. I think, like Adrie also said, we are not dumb, deaf, and blind as portfolio managers. What is going on in the world? So we have our own assessment on these new frameworks, and then we discuss it with the responsible investments team where it suits our needs. And it's a human dialogue indeed. So we came up, for example, for Schiphol, we did decide to label it. We label it as bio, belegging in oplossingen, investment in solutions. So that's another outcome than NNIP had, for example. On the other hand, at the Polish green bond, we did not invest initially because it did not make the hurdle, in our opinion. So it's not black or white, I suppose. That it's a human dialogue, and sometimes it also depends, I guess, on who you're asking, and it's very personal. And maybe as a final point, I would like to mention that as we are moving towards SDGs from our 4 thematic areas, we will be targeting all SDGs, but within those SDGs, there will be a few focus SDGs. And for those focus SDGs, we are going to try to see if we can double the impact. So impact reporting on those focus SDGs is becoming quite important for us, and we really want to establish some standards there.
Thanks so much. Very, very helpful. I think we saw also one of the things I saw in the time of the COVID, I think APG was bringing also a list of criteria for them to consider a bond being part of the COVID bonds and COVID responses. And there were one point as, user proceeds going to charity was also not fit. So I think this is really, each investor will have their own criteria. And it takes me a bit, it worries me still a bit because, social problem are quite standards. And, I'm trying to think, we've been able to find a general taxonomy for Europe and general what are actually a green product. There's a big consensus there. So a question to all of you, actually, who would love to answer. it took us almost 12 years with the green bonds to come to a standard. I hope for the social part we're going to get faster. I know the European Commission, is looking at the green taxonomy, and they want to look at social. But what do you think needs to happen? How far to further build the market and to go into more standards so that we all speak one language and solve the same problem? Because these social problems are social problems. Who wants to start? Chris?
Okay, maybe I have a start here. So yes, the green bond market is growing very impressively, and it's really evolved over time. And you're right, the social bond market needs to do the same thing. And maybe what we need to see is, as we saw in the green bond market, we need more corporates to come to the market and issue social bonds. For example, it's not only banks, but maybe pharmaceutical companies as well, or even telecom companies. So we need a lot more corporates to come to the market to help develop the market. We have corporates already, such as Danone and Deutsche Credit Bank and BBVA and others, but we could see a lot more. You saw earlier, it's only about 14% of the market. And also more government social bonds. What was a little bit disappointing for me was we did see governments come to the market and issue COVID-19 response bonds, but they chose not to use the social bond principles or the sustainability bond principles. They issued general corporate purpose bonds. So we don't know where the money actually went. The money could have gone towards employment generation or healthcare, but it could have gone elsewhere as well. So I'd like to see governments issue social bonds as well, but with a fit to the social bond principles. And then just echoing what you said, Sophie, earlier about impact metrics, I think we really need to see that develop. So at the moment, it's just based on populations, but are they really, how much can we take from this data? Is, for example, an improvement in education, say an increase in textbooks, does it mean the same thing in Brazil as it does in Kenya, for example? Should we be looking to establish baselines, maybe regional baselines? I think there's a lot more thought that needs to go into this, and it needs a lot more development. Just going back a stage to the green bond market and impact reporting, the green bond market went through various phases. So several years ago, the multilateral development banks were very good. They got together and they produced a harmonized report for impact reporting. And then a couple of years after that, the Nordic institutions got together and collaboratively they worked together on improving impact reporting again. And I think we need, and they are doing it. These reports are available on the website, ICMA's Green Bond and Social Bond Principles. And I know that participants there are working on social bond impact reporting as well. But there a lot more work needs to go into this. And I think, there's an old saying, if it can be measured, it can be managed. And so we need these metrics so that we can manage the situation more effectively.
Adrie?
Yes, thank you. I sort of agree with Chris on this, but my tagline would be, yes, we think move much faster nowadays than in the past, because we're now more used to it. It's much more lingo. We have the SDGs, and actually we're almost half there. So we need to step up our act. So I do think there will be a sort of sense of urgency or sense of pressure much more in the next I think 2 years on this, that also people come to a common understanding. And I think although the EU taxonomy is much more on green and other stuff, but I think also on social and transition, things will become more clear. Or I do hope that some investors or some groups of investors will step up and say, well, let's start to find something which we agree upon. This is what we move, we fix it, and then let's go and provide feedback, and then we get something. Because I do feel that, especially also with other parts of responsible investing, it is a bit like we do see with this webinar. We look at each other and see, well, should I start first? So in my view, out there, it's a dancing floor. Music is playing. So who will be the first two? Because it takes two to tango to step up on the dancing floor. And I do have the feeling that next year people will do step up, because otherwise nothing's going to happen. So stand up and start dancing. That's the tagline.
I want to add something. I don't really want to start dancing. However, why should I even care about social bonds if I invest in Dutch government bonds? Because I know they're spending a certain percentage of the budget on education, healthcare, etc. So I can say I'm really adding to the social development of the Dutch society by investing in Dutch government bonds. Why should I even take the hassle to dig into all these requirements, etc.?
No, I think you asked a question to me, so I immediately step up to the dance floor, so to speak. Now, it is a figure of speak, of course, Kim Tien, and it is. I'm not going to say if you have to or convince you that you should, but if we want to issue these type of bonds, I think there's a sort of pressure cooker going on that we should be more clear what it is exactly. And I think on certain governments, definitely you could say that if you invest in the Dutch government, you do also invest in schooling and other stuff. If you take US Treasury bonds, something else is going on. So there should be a sort of thing. So I'm not here to convince you, but if this is something that we want to do, we should be more able to do it. And I think that the common language and the common lingo and also the common need, and I think sometimes again, being fully transparent, we have some clients who really want to go in a certain area. So therefore, we also looking for, and we developing for them, maybe this could be a framework, maybe this could be your way of putting it there. So the dancing is much more metaphorically. Let's move on. Let's get going.
Yeah, I think I would love to add something to that, Kim Tien, because we had before also the comment of PGGM policy, for instance, from Wilfried about making an extra commitment to invest towards 4 different themes. And we see a very larger number of investors who actually want to actively support education or healthcare or certain thematic or more social, actually local impact. And they will, if the bonds would have a very clear use of proceed, and we know that it will really go there, I could imagine if the return is the same and the expectation is the same, but they will decide to choose to one or better than the other. So that's what we've seen happening for certain of the investors. And it takes me to a question which I come in on that. What would be the comparative advantage for investors over another investment? So if it's the same, I think that's answered a bit this question. But can somebody maybe deep dive a bit on that comparative advantage from a social or a green bond over a traditional, if any?
Yeah, I guess the added benefit for an investor is quite clear. It's the extra transparency you get on the proceeds which you are being invested in. So we can explain to our customers, which is the Dutch pension fund of the healthcare sector, what has been done with their money. And we do it in an integrated way. So you can look at pggminvestments.nl or .com, I'm not sure exactly, but you can see the integrated report of 2019, and there we explain not only the financial result of what we have done with the pension money, but also the social results. So how much CO2 has been saved, how much gigawatt of renewable energy has been produced, how many wastewater has been treated. And this is across all asset classes. It's across equities, infrastructure, private equity, but also the fixed income space. So it creates the opportunity to explain to your constituency what has been done with their money. That's the biggest advantage, I guess. And then the second advantage is not so much to the investor, I guess, but also to the issuer of these bonds, is that they get the dialogue going. So what we also hear every time when we speak to issuers of green or social bonds is that within that particular company or sovereign, different departments start talking to each other. So the Treasury Department starts to talk to the other department who lends out the money and speaks to the people on the ground, because they have to hand them the KPIs. And by getting that dialogue going within the particular company or sovereign, this is an added benefit for society as a whole, I guess. And yeah, then again, I agree with what has been said earlier. This should not come as a discount because we have a fiduciary duty to our clients. So you get the same financial return normally, indeed, for green or social bonds. And indeed, if there is an advantage in the secondary market to sell those, we're quite happy to sell those if they trade below the curve and then reinvest the money in primary new green or social bonds. So yeah, I think there are quite a lot of benefits to investors of looking at those markets.
I have one more question. I just ask all of you, please. We're coming to the end of the 2 hours, so I can definitely happy to have anybody raise their hand and say I would like to ask a question. I'm thinking now at COVID crisis. Where do you think we should see more insurance or more investment into more the social and towards the green, or how do we, how can we contribute to that?
Yeah, this is Adrie. Well, let me be a bit of a preacher here. I do hope that there will be no cannibalism on these things, but that both will sort of be growing, and that both demand but also supply, because that was also mentioned by Chris. We need issuers, we need corporates, but also maybe local or governments to issue these type of bonds to make sure this. So I'm gonna. My view is that things will be still a bit more on the green, but that slowly but surely other things will also pop up. But I think for green, it is relatively easier. And looking forward, I think we're going to have some issues with global warming. So let's make sure that issuers, companies will really make sure that they're going to make the investments, and therefore they need to probably issue some green bonds. This is, to paraphrase Jurgen, also my personal opinion.
Maybe if I can add,
Go on.
During discussions that we had with a couple of issuers and also ongoing discussions with them, you see that some of them are slightly reluctant or a bit hesitant to issue bonds with a certain label, to put it as a social bond in the market or as a green bond in the market, purely for reputational damage potentially. So if you put it in the market as a social bond and there is in one particular part of your company there's a small risk that something is not, that there is some corruption or whatever, then the whole press in particular will get over you and say well, why are you calling yourself being an issuer of social bonds? So there is some risk, and I think therefore one of the elements that we wrote, we would love to see more standardization, like in the green bond principles, social bond principles, which gives some assurance also to those issuers to be more able to come up with to issue a social bond or a green bond or whatever.
Anybody wants to come in?
Yeah, so generally speaking, I would really love that a lot of governments and corporates would issue more green and social bonds, because it will make everything much more transparent. They would have to disclose much more information. And also for an investor, it's good to have more choice. You get a more liquid market. You can easily compare it. So I really hope for the benefit of actually everybody, the society, investors, and also for the planet, etc., that there will be much more green and social bonds issued, and blue, brown, everything.
So I think we have 10 more minutes. I think we've been quite good in time, and I'm, happy we all start exercising a bit for the last two. But yeah, I would like to thank you, all of you, for this really active participation, for all your questions, and for the two commission for making that happen. Irma, I think we're coming to the end of all the questions. We answered quite a lot, so I've been quite happy about that. I'd like to thank you, all of you, and Irma, is there anything we forgot to ask? No. Good. Then on this word, I wish you all a very happy anniversary for the SDG. Thank you very much for being here, and yeah, speak to you very, very soon.
Thank you so much, Sophie.
Bye-bye.
Thanks.
Bye-bye.
Thank you very much. Thank you. Bye-bye.
Thank you. Bye.
Bye, Wolf.
Bye.